Good morning, good morning, good morning. Welcome to Time in the Market, the investing channel with a long-term focus. Wanted to have a quick video about Netflix. I talked about Paramount a couple of weeks ago in another video where I briefly covered Netflix, and I think some of the comments I made were very prophetic of what actually happened when you saw the earnings and how the market reacted to them. There was talk in that video about, hey, Paramount looks like a good deal against Netflix. They are pushing forward more and more competition against Netflix, which used to be the number one player in this space, but really is facing more headwinds. And those headwinds are finally being seen in some of their earnings as growth has actually stalled out and has gotten lower for the first time in quite some time. They just announced earnings, reducing their subscriber count by about 200,000. I think some of that was due to the stopping service in Russia, but it's still less growth than they expected. And they also said that in the next quarter, they would plan to lose about 2 million subscribers. All that led to a pretty big sell-off, a one-day drop of 35%, which again, this is not a small cap stock. This is a large cap stock that is dropping 35%, losing 50 billion in market cap in one day. What a market we live in. So what is going on with Netflix? Is it a good buy today? First, let's take a look at the earnings. As always, guys, this video is for informational purposes only. I am doing this for fun. I am not a qualified financial advisor. Please do your own due diligence. Talk to a qualified financial advisor before making any investment decisions. In the letter from Netflix, they basically said, hey, there are some headwinds happening. A lot of their growth was accelerated due to the pandemic. People stayed at home. Everybody subscribed to a bunch of streaming services. Suddenly, these stocks were up 50% in a matter of months, just like a lot of other growth technology stocks. I mean, you can see that in the data here. Prior to the pandemic, they were at 325, soared all the way to 700, close to 700, and are back down to prior to prices that haven't been seen since before the pandemic. Even though at this point they have 200 million subscribers, they're a much bigger company than they were prior to the pandemic, and their earnings are a lot better because of that, right? So valuations obviously have stabilized. But the problem is the go forward picture is a lot more murky. They are not growing anymore. Q1 was a sequential reduction in paid additions. Still grew over Q1 21, but smaller than Q4 21. And then Q2 22 forecasted for additional 2 million in losses in terms of paid members. Revenue is still growing. Operating income is still decent. Operating margin is still decent. They're still making money. They are still free cash flow positive, which is a problem back in the day that was discussed with Netflix, that they were taking on debt to fund all of this entertainment that they had on their service. But that is no longer really the case. They are self-funding that, and hopefully will be able to self-fund that going forward, because if they lose that ability, this is going to become a problem, because raising debt, taking on additional debt in a higher debt environment, higher yield environment, is going to be a problem for them. Raising additional money via stocks is probably going to be a problem given how far they've fallen. But right now they're in an okay spot from that position, because they do have to spend a lot of money on content. And I talked about that in my Paramount video. This is a content heavy business. This company has always been priced as a tech company, but it is still in the business of making content for the most part. Yes, they have a tech platform. They were the first mover in a space that has become more crowded by the day, but all of that is catching up to them, right? They have this negative part of their business in comparison to some of their other competitors like Paramount, like Disney, like Warner Media, which has HBO Max, in that they have to essentially become a studio, because the licenses they once depended on, the licenses that helped them grow, if you go back to their growth period, kind of seeing this 30% growth for a couple of years, they were able to do that on the backs of ineptitude from other companies. Disney was selling them their licenses on the cheap. Warner Media was selling them the licenses on the cheap. Paramount was selling them the licenses on the cheap because they didn't have their own streaming service. And essentially, it was a one-horse town with Netflix, and they were able to buy all this content, and people loved it because they were able to go to Netflix, and they were able to get all sorts of movies, all sorts of television shows. Netflix started making their own originals. They were one of the first ones to do streaming originals, high-quality originals in the beginning. We'll talk about that more later as far as what's become of that. But essentially, they became a one-stop shop. They were able to grow membership really quickly. They were able to grow revenue really quickly. And the market valued it because of that, right? The market saw, hey, we're getting 30 to 40x, 40% growth year over year in revenue. This is quickly becoming a free cash flow positive business when it came to 2020. The issue here was that, hey, you could see that even though they were growing revenue, they were burning a lot of cash prior to 2020. In 2020, they kind of stopped making some of their shows because of the pandemic, so they were able to get free cash flow positive. In 21, that continued, so people like that. But now you're hitting the pause button on this investment because you're seeing that, hey, maybe they're peaking. Maybe this is really where their growth story ends and they become more of a value stock. And that's what you're seeing in this reduction in price. If you look at their valuation prior to this announcement, you can see that this was a 7 to 9x multiple stock, and suddenly the brakes are hit and it's become a 3x forward multiple stock, right? So these are prices as an investor you haven't really seen since 2015 when this growth story was just getting underway. So the question is this a good investment right now, or are there still problems ahead? And for me, I think the latter is more likely than the former, because Netflix has become a bit of a different animal than it was in 2014, than it was even up to 2019, 2020, as more and more competition launched. You've got HBO Max really putting out solid content. You've got Apple TV Plus putting out really solid content. Apple TV Plus is, in a way, what HBO used to be, in a way what Netflix was at the beginning, where it's low quantity but high quality, and that's really where they're making their bread and butter. You've got Paramount Plus coming out with some okay content, but people have more and more options they can subscribe to, and it's very, very easy to basically say, hey, I'm going to cancel this service for a couple of months or forever, and I have all these other services that I can depend on that are now much, much cheaper than Netflix, because that's another problem we have to talk about. Netflix has kept on raising and raising their prices to a point where they're not market competitive anymore. The 4-screen service that contains Ultra HD is $19.99 per month. That is a very high price and makes it very easy to cancel. The second price point, which is the one that I subscribe at, is $14.99. That gives you 2 screens and regular HD, and then you've got a $9.99 service that doesn't even have HD. I mean, who does that? I think all of the other services have HD included in all of their packages, and now Netflix is pricing themselves out of this highly competitive marketplace that is becoming better and better in terms of the quality that other people are putting out, and worse in terms of the quality that Netflix is putting out. Netflix has become this thing where they are masters of none but good at all, right? They're trying to focus on too many things at once, and they're putting out things that they think everybody will love, and as a result, they're alienating the people that want specific high-quality content. Like, it's the stuff that shows up on my screen these days. It's like reality shows times 5 with maybe 1 or 2 movies that are kind of mediocre at best, with maybe a couple of shows that are decent every once in a while. I think the last thing I watched on Netflix was The Witcher that I enjoyed, and that was months ago. Otherwise, it's like, what am I even subscribing for, right? And as you look at 200 million people on there, that's not nothing, but how can they continue to grow that? Because at the end of the day, there is still upside here. If you believe that Netflix is a solid service, if you believe that they can turn this around, that they can start growing again, or even stop the bleeding and keep their prices where they are and continue raising revenue and eventually start growing again by maybe adding a an ad-supported cheaper service that some people do for some reason enjoy, then the valuation here is interesting, right? At the end of the day, you're looking at a valuation that's sort of similar to what it was in 2014. Now the growth story is different, so you can say that that's a negative, but you've got 210 million subscribers. You've got a total addressable market that's close to a couple of billion, right? As this expands worldwide. But I think they've reached a point in the United States, at least in some of these domestic markets, where there's saturation now. And that's a problem for investors. And that's why you're seeing some of these revenues, some of these multiples start to slip back to where they were when the growth story was a lot better. So if the growth story is a lot worse now, but they're a better business, is that an enticing investment argument? To me, not really. And that's for a couple of reasons. If you still look at the market cap here and you look at some of these estimates, this is still a $100 billion business. So it's a $100 billion business that's growing at maybe 9 to 10% a year at best, that has headwinds ahead of it because there's multiple competitors that are also growing. And if there's a potential, if there's some potential issues with the economy, services like this are going to be the first to cut. It's very easy to cut Netflix when it costs you $19.99 and you've got some economic troubles ahead, right? With inflation where it is, with people spending more money on gas and other things like this are going to get cut. And that's why you're seeing some of these membership headwinds. On top of that, in 2022, they're projected to have about $800 million in cash flow. Again, that's against $100 billion market cap today, $111 billion total enterprise value. Even on a go-forward basis, by 2025, maybe if things turn out the way they are projected to turn out, they'll have about $5 billion in free cash flow, which isn't terrible given their enterprise value, but still, 2025 estimated 5% cash yield. Is that really all that interesting in today's market when you can get 4 to 5% today cash yield for something like Google, which also has a streaming platform in the place of YouTube? I don't know. I don't know if this is all that interesting to me. And what worries me more about this is what I talked about earlier in my other videos. They have to spend a lot of money on content. And as they start to kind of lap their growth opportunities and their revenue growth starts slowing, that content is going to become more and more competitive, right? And if that content starts to cost more money to make, are they going to be able to compete with some of the other players that already have that stuff built in to their business model? Like I said, Paramount Plus is a movie studio and a television studio first. So a lot of the content they are making is already funded by all of the stuff they have in-house there. Same story with Disney, right? They're able to make a Marvel Universe movie. Doctor Strange is going to come out. It's going to cost $300-400 million to make, but it's going to make $1 billion plus in the box office. It's going to spend a little bit of time there. People are going to buy that crap on DVD because people still buy DVDs for some reason. People are going to buy toys and all of that nonsense. People are going to go to Disney World, etc. People are going to get excited about the next Marvel Universe movie that's in line because they saw Doctor Universe and is going to set something up into the future. They're going to subscribe to Disney Plus because there's a bunch of TV shows there. And Marvel is going to make additional money by putting that movie on television somewhere, but also by putting it on their streaming service because that's how their business model works. Netflix doesn't have that, right? They don't have anything beyond their streaming service, right? They're not going to make extra money from putting it on television. They're not going to make extra money from selling DVDs. They're not going to make extra money from the box office on the majority of their movies. They do release some in movie theaters, but none of them are that big. But they are going to spend $200 million on some crap movie like Red Notice that's going to show up on your screen one Friday. You're going to watch it and say, yeah, whatever. And then it's kind of never going to be seen again because Netflix also does a mediocre job of kind of curating an experience for users these days that is making users want to stay with their platform. Like I said, and maybe I'm alone in this, and if you disagree, this might change your investment thesis. But when I look at the front page of Netflix, I just kind of see stuff that I'm not interested in anymore. And for me, that's a problem, right? If I want this to be an investment I want to be interested in, I have to, in a way, like the product, especially when the product is so user focused as Netflix, right? That doesn't have to be the case with every investment, right? I might invest in an oil company. It doesn't mean I have to like oil. But when I'm talking about like Disney and customer facing companies, a lot of the times I have to know that the product they're putting out is good. And I think 5 years ago, I thought that was the case. 7 years ago, that was definitely the case, right? When I looked at Netflix 7 years ago, it was the best deal of all time. But as good deals go, they catch up to you, right? They were able to grow on the fact that they were able to get to all those cheap licenses. They were able to have all those properties, all that IP under one roof. But now that all of these companies have taken back their IP, that they're putting out their own services, that they're competing with Netflix, the content that's on Netflix just isn't very good anymore. They maybe have a 10% hit rate on their originals because they're trying to focus on everybody out there. And when you focus on everybody out there, you're a master of nothing, right? HBO Max has better television shows now. HBO Max has better movies now. Disney Plus has better television shows now. They have better movies because they have all their own original content. Hell, even Apple TV Plus has better television shows. They had the Oscar winner recently. What does Netflix have these days? Sure, they have a couple of good television shows. They have a couple of good movies. Adam Project was okay. Like I said, The Witcher's good. Probably some other things that are good. Some decent IP. But is it good enough to continue this growth story? Or is the stock becoming more of a value name going forward? And by these projections, it's starting to become more of a value name. Now, that doesn't mean that it's going to be a terrible investment at these prices. It just doesn't mean that the prices that you got used to as an investor in Netflix, the $600, $700 stock that it once was, it's not going to be that anymore. That's why this drop happened, right? Because it's quickly valuing it to what the new estimates are becoming. Now, if they can change that story, if these estimates can grow again, if they can start expanding, at today's prices, this could be a great investment, right? Because now, as far as the valuations go, you're back to a very reasonable multiple, right? 3x is basically in line with the S&P 500 on a stock that up until yesterday was a growth name. Up until a couple of weeks ago was a growth name. And now suddenly it's this pariah. Now, this isn't a terrible company by any means, and at today's prices, it's not a terrible investment by any means, because I think by 2025, 2026, they can be tossing out a decent amount of cash flow. They might be able to do something with that cash flow in terms of buying back stock, in terms of buying back dividends. Their balance sheet today isn't terrible, which is a good thing because they have cash on the balance sheet. They're starting to lower their debt. They still have some debt on the books, but as long as they can continue doing that, as long as they can continue, growing their revenue at a small clip and keeping free cash flow positive, then this will be an okay investment at today's prices. However, when you look at the stock market today and some of these other tech names that have fallen 50 to 60 to 70%, is this okay investment better than some of the other investments that are out there? And in my mind, not really, unless I see something change, unless I see the content get better. Another issue with Netflix is they cancel a lot of stuff, right? They'll have a good show that'll get 1 or 2 seasons, and then suddenly it's gone because for whatever reason, their internal data doesn't think that people like it. But the problem with that approach is that a lot of the best shows, they're not popular right away. A show like Breaking Bad took a couple of years to get going, and then it became one of the biggest hits on Netflix because they were able to get that license cheaply, and they're probably going to lose it eventually. But if it was on Netflix today, would that show even get more than 2 seasons, or would they cancel it right away? This is the whole thing with television back in the day where they were canceling things. Netflix needs to stop doing that. They need to focus on quality content that they let live, and they need to focus on curating the experience to the user in a better way. I don't need to see Love is Blind on my front screen because other people are watching it. I don't want to watch Love is Blind. That's just not for me. I don't want to watch some stupid Nick Lachey reality show. If I want that crap, if I want House Hunters or whatever, I can go to Discovery Plus. I can go to whatever. I subscribe to Netflix because I wanted to watch good television, good movies. And again, I am not every user, right? I'm not saying that. But for me, Netflix has become a shell of itself in the last couple of years. And it's not crazy that this is how the stock is reacting. It's not crazy that users who suddenly log on and see, hey, your $12.99 price is suddenly $13.99. Oh, a couple months, a year later, it's now $14.99. And is it going to keep going up? Why do I even want to keep this? Why am I going to pay $19.99? And they've got this idea of people are sharing passwords. Well, that's because you tweeted out a couple of years ago that sharing passwords is caring. Yeah, people are going to share passwords with their family, with their friends. That's just how it works. If you start limiting that, there's this idea that, hey, we have 100 million people that we can hit if we stop limiting passwords, if we charge people more money to share passwords. I mean, I already subscribe to an account that allows me to have 2 screens. People subscribe to an account that allows me to have 4 screens. That's what they're doing, right? They're sharing passwords outside of their household. If you want to stop that, you certainly can. And that may lead to more revenue, but it also may lead to those people just canceling and not subscribing at all. If I'm sharing my password with my family and they say, oh, you have to pay $2 extra, I'm just going to cancel. If somebody else is sharing their password and they have to say, oh, you can't share it anymore, they have to subscribe on their own, they're probably just not going to subscribe, right? There's other services out there now. There's choice. And that choice makes this a less compelling investment because this is such a investment heavy business to be in, right? They have to spend $17 billion a year. If you look at their cash flow statements, right? They spent $17 billion, $18 billion this year on content. And that number is not going to shrink. They're not going to just be able to say, oh, we're going to spend a bit less. Because there's other competitors out there who are spending more. And they have all of this pre-built content from their TV channels that they have ad money on, that they're making money on, from the box office, from other parts of their businesses. And just this streaming approach, it's no longer unique, right? There's 5 other streaming services that are growing quickly, that are taking a bite of the apple, and Netflix has to do something different. I just don't know what that is besides focusing on quality. And right now they're not doing that. So for me, this is a stay away. And again, if this stock keeps dropping, if this valuation suddenly says that, hey, maybe by 2025, you'll have a 7 to 8% cash flow yield, then it'll get interesting. But right now, it's just an okay investment. And it's an okay investment in the sense that, hey, maybe this will return the same as the market until and if this changes for the positive, right? If this thing can start growing at a 15 to 20% clip again, yeah, today's prices are great. But if the story going forward is, hey, we're going to maybe kind of tread water with our membership and maybe our revenue is going to grow at 9%, and I'm assuming this 9%, 10%, 11% growth means that they're returning back to growth because, again, yeah, they're growing 9% this year despite losing membership, but that's because they just recently raised prices. They can't keep raising prices that far above where they are today. There's just a level at which people will say, I'm not paying $25 for a streaming service. It's just not happening. And I think they're starting to see that this is the level they're at, right? They're at $14.99, $19.99. I think raising prices beyond this is going to be hard because you're getting to a point where, if you bundle all these services together, you're paying $80 to $90. It's kind of cable prices. And again, this is what people wanted. This is still way better than cable because you can pick what you want. You can sort of cancel whenever you want. But people are not going to keep up with a ton of price raises going forward. It's just not going to happen. And now as you see other companies kind of move into the sports space, change their, Apple TV now has baseball. Apple TV Plus now has baseball. Amazon Prime, I believe, has football. Netflix is not in the sports space at all. They're trying to target a bigger audience with a variety of shows, reality, dramas, comedies, etc. But again, too many cooks in one kitchen might lead to an issue. If they start cutting back in spending, which I've seen that they're trying to be more organized with their spending, how is that going to impact the amount of content they release? Is it going to be good content? Again, a lower amount of content that's good is better than what they have today, but hits are tough, right? This is a 2 out of 10 business. You can make 10 TV shows and 5 of them will be good, and that's an amazing hit rate. So that's something to keep in mind, right? They still have to produce quantity and figure out what's quality and kind of focus on some of that stuff and see what happens there. So again, not a surprise that Netflix is where it is, not a surprise that this is a stock that has been a little bit shunned by the market. Today's price is certainly more interesting than it was a couple of months ago, given the competitive nature of this space, but still not something I'm all that interested in right now. But I will keep an eye on this because Bill Ackman just sold his entire stake that he bought 3 months ago. I think there's going to be more pressure on this stock. If it gets into the 100s, I may take another look at it. Right now, though, it's too much of an unknown. It's too difficult in terms of projecting membership going forward because it seems like they've hit a peak. It seems like they're not really going anywhere from here, or at least not going anywhere amazing from here. You know, if they can tread water in terms of membership while they figure out what to do, while they see if there's an ad-supported business model they can work with, since a lot of other players are in that space. I mean, if you think about it, that's why Disney works, because they have TV stations that kind of subsidize their streaming business. That's why HBO works, because, you know, they have a bunch of stuff that subsidizes their streaming business. That's a similar-ish deal with Paramount. That's kind of what I talked about when I said I like Paramount more than Netflix, because they have this business model that subsidizes their streaming business, and the market's pricing that at like 6x earnings, because the streaming business is a competitive business. It's a business you're probably supposed to lose money in until you're at a grand scale. And Netflix has kind of hit that scale faster than others, but now what happens? Can they grow beyond that, or is this kind of where they end? Because if they can't really grow beyond this, this is not going to be a great business on a go-forward basis. And that's a TBD. With the 12 different competitors in the space, it's a difficult TBD to determine. So for me, you know, unless this becomes an obvious, wow, this thing is at 1.5x sales and it has a 7 to 8% future cash flow yield, if they can even keep growing at a 8 to 9 to 10% clip, then I'll be interested. But for now, I think there's better plays in the market. But let me know if you disagree. Guys, let me know what you think about Netflix. Are you surprised by this drop? Are you a buyer at today's prices, or are you staying away to see what happens? Again, difficult market. You can see that stocks can drop 35% even if they're 100 billion plus companies. I'm really eager to see what Google does in their earnings coming up soon. I really like Google. I am long Google. I am long Netflix, but I have a very small position right now that I may just end up selling. I'm talking about, like, I literally have maybe half a share of Google in my M1 account, of Netflix rather, in my M1 account. I have more shares of Google, because it was part of my entertainment pie. So may get rid of it because streaming is just a bit much right now, and this does put pressure on some of the other streamers. Paramount might get interesting again. Warner Bros. Discovery might get interesting again. Disney, with all their Florida issues, might get interesting in a bit of time as well. And I think if some of these other tech players announce earnings that are mediocre, Tesla's earnings were pretty good. But if, hey, Google comes out and the earnings are mediocre, or Microsoft or Apple, there could be a market correction beyond what we've seen already. Some of the smaller cap, mid cap, even some of the lower end of the larger cap has corrected in a big way, you know, 50 to 60% corrections like Netflix, but the large cap names have been relatively steady, and those have been the steady eddies. If that changes, the market could have some issues. So we'll see what happens there, guys. Let me know what you guys think about this video, what you think about Netflix, what you think about some upcoming earnings. Are you a buyer of Netflix, or are you a seller? Thanks for watching. Have a good rest of your day.